Adverse selection arises from the fact that individuals are heterogeneous in their risks of the bad event occurring. So when we talk about the risk, we mean the risk of the adverse event occurring. You getting into a car accident, you getting ill, it raining. Whatever the bad state of the world is, the risk is the probability you enter the bad state of the world. So people have heterogeneous risks in the sense that people have different probabilities of entering the bad state. Insurance companies can't tell your risk type from looking at you. There's asymmetric information. The insurer has less information about your risk type than you yourself have about your risk type. There's an asymmetry. You have more information than the insurer. So individuals know more about their risks than do insurers, making it difficult for insurers to charge individuals their own actuarially fair price. So if we lived in a world where your risk type was tattooed across your forehead, right, it would be very easy for insurance companies to charge every individual the actuarially fair price for their insurance premium, and we would have full insurance, right? We have well-functioning insurance markets. Because people are different, because there are heterogeneous risks and asymmetric information, insurance companies face what we call adverse selection. When they offer insurance, the population that shows up, or the people who show up to buy insurance, are not representative of the population as a whole. They're more likely to be the high-risk type. Their average risk is much greater than the population as a whole. They're adversely selected into choosing insurance. Adverse selection means that individuals with the highest risks are most likely to want insurance. Thus, insurers charge a higher premium that is actuarially fair for the population on average, right? They're trying to guess what the risk type of the people who show up is. And that actuarially fair attempt to price for those who show up, rather than the population as a whole, leads to the insurance being much more expensive than the low-risk type wants to pay, right? It'll be higher priced than is actuarially fair for the low-risk type. Let's get concrete. What we're going to talk about today, in the first part, is the difference between pooling and separating equilibria. So when there's a market failure in insurance markets, what we mean is that there's a quantity gap. There are individuals who seek insurance but are uninsured, or would like to get more insurance than they're getting. They're only partially insured, but they'd like to be fully insured. That's a market failure. It arises from the low-risk type choosing not to buy insurance because of the pricing of insurance due to adverse selection. But asymmetric information and adverse selection don't always lead to market failure. It leads to market failure when there's a separating equilibrium. When there's a pooling equilibrium, we can in fact have an efficient market, although the low-risk type will be paying a lot for insurance. So asymmetric information does not always cause market failure. Low-risk individuals may in fact still choose to buy insurance when insurance costs more than would be actuarially fair for them. And they would choose to buy insurance in that case when they're extremely risk-averse, right? If the low-risk type is sufficiently risk-averse, they may choose to pool with the higher risk types and buy insurance that is priced above the actuarially fair price for their type. A pooling equilibrium is where all types buy full insurance, even though it's not fairly priced to the low-risk type. This is an efficient market. There's no market failure. Everyone is fully insured in that pooling equilibrium. A separating equilibrium arises when the high-risk type buys full insurance, but the low-risk types are not sufficiently risk-averse to want to pay that higher than actuarially fair premium. In this case, there is a market failure. Some individuals are either uninsured or underinsured, and those are the low-risk types. Okay, let's do an example. We're going to talk about car insurance. There's a population of drivers. Half of all drivers are snails, and they face only a 1% risk of getting into an accident. The other half of the population is what we're going to call racers. Racers have a 5% chance of getting into a car accident. The cost of a car accident is identical across types. It's $12,000. And there's no other consumption or assets. So what I'm saying is if an individual gets into a car accident, they have a consumption level of 0. If they don't get into a car accident, they have a consumption level of 12,000. If insurers have full information about drivers' types, they can tell snails from racers. Everyone has a snail tattoo across their forehead if they're a snail. They have a racer tattoo across their forehead if they're a racer. So full information is available to insurers. So if insurers have full information about drivers' types, and the market for insurance is perfectly competitive, i.e., insurance is priced in an actuarially fair way, how much will insurers charge each type of driver for full insurance? So go ahead and work it out, and then we'll do it together. And just kind of look up at me when you're done so I know that you're done. Okay, let's take a look at it. So what does actuarially fair mean? It means that the insurer is going to break even on average, right? So the actuarially fair premium is the product of the payout the insurer will make in the case of the bad event times the probability the individual enters the bad event. So in this case, for a snail, right, that number is 1% times 12,000, also known as 120. In the case of a racer, it's 5% of 12,000. Or $600. In this case, when the insurance company can say, hey, you're a snail, I'm going to charge you $120 for full insurance, or you're a racer, and I'm going to charge you $600 for full insurance, both types are happy to pay, because we're assuming that there's some risk aversion here. And we know from last time, right, that as long as the individual is risk averse at all, they will want actuarially fairly priced full insurance, right? If they can buy full insurance at an actuarially fair price, that's what they want to buy. Remember we did the utility comparison last time? That's right. So in this case, the insurance company will charge them different actuarially fair premiums for full insurance, and each type will choose to buy actuarially fair insurance and full insurance at that. So the market is perfectly functioning with full information. But that's not typically true, right? Typically, there's asymmetric information. So let's imagine a world where there are no tattoos revealing driver type. And their insurance company simply looks at the population and can't tell who's a snail and who's a racer. So now suppose insurers don't know drivers' types, and they're going to have to charge a single price to all drivers. They can't tell them apart, so they have to charge them one price. The insurance company kind of scratches its head, right? The insurance company owner scratches his head and says, you know what? I guess, I don't know who is a snail, and I don't know who is a racer. But I know half of them are snails, and half of them are racers. So I guess I'll charge them the middle premium. I'll just charge them all the average premium between snails and racers. So you add 600 to 120 divides by 2, and he comes up with 360. He says, okay, full insurance against getting into a car accident with a payout of $12,000, and the premium is $360. How do the two types of drivers respond to this insurance policy? How do racers feel about it? Really good, right? Because actuarially fair pricing for them is $600. They're getting to pay a lot less, right? They're getting to pay $240 less than is actuarially fair. How do snails feel about it? Less awesome, right? Will they choose to buy insurance? Maybe, exactly, maybe, because it depends on how risk averse the snails are. Let's take two situations under consideration. Let's imagine we have more risk averse snails where their utility function follows log of C. I'll clarify that in a second. Or a less risk-averse snail whose utility function is the square root of consumption. Now let me clarify the first one. My shorthand, as economists, we often use the shorthand of, utility is log of C. What's log of 0? Log of 1 is 0. Log of 0 is undefined, right? So when I say it's log of C, what I'm really saying is that it's a two-piece function. It's log of C as long as C is greater than 1. If it's less than 1, when C is less than 1, utility is 0. I'm just going to fix the problem with the log function, right? So utility is always 0 or above is what I'm saying. Does that make sense to everybody? Okay, great. Are we all on board? And I'm going to tell you right now, many of you are familiar with the log function. Some of you are less familiar. It's been a few years since you've met your friend, the log function. But don't worry. I mean, we should all be friendly with the log function, but it won't haunt you on exams. I'm not going to expect you to actually enter numbers in the log functions, no, not on an exam. So know the log function, be friendly with the log function, don't let the log function stress you out. Okay, let's get back to our problem. So we said snails might buy insurance even at this higher than actuarially fair price, depending on how risk averse they are. We're going to consider the case of a more risk-averse population of snails and a less risk-averse snail population. So remember, I said last time that there are 3 statements I could make that all mean the same thing about risk aversion. One is you're risk averse, you're more risk averse. It's the same thing as saying your utility function has more curvature, and is the same as saying that you have faster diminishing marginal utility. Faster diminishing marginal utility, more curvature in the utility function, more risk averse, all mean the same thing. So log of c, this function has more curvature than the square root function. Marginal utility diminishes faster with the log function than with the square root function. And the log function means you're more risk averse than the square root function. Okay, let's go ahead and do a problem. So if the snails are more risk averse, so their utility function follows this log form, except when c is 0, utility is 0, what is their expected utility with and without full insurance? Where the insurance policy costs $360 and provides full insurance. This will take you a few minutes. Look up at me, please, when you're done. Come on in. So there's 2 handouts. And we're starting off with this one. Yeah, sure. Okay, let's go ahead and take a look at it. So when we're dealing with expected utility, what we're really doing is taking a weighted average of utilities across states of the world where the weights are the probabilities of each state of the world. Right? Expected utility is a weighted average of utility in different states of the world. We weight by the probabilities of each state of the world arising. Okay, so let's go ahead and start with the expected utility when there is no insurance, when they just face the gamble head on. So we know at the 99% probability, they'll have their car and they'll have a consumption level of 12,000. So they'll have a utility of log of 12,000. We multiply that by the 99% probability of that event occurring. We know there's a 1% chance that they will have an accident and have a utility level of 0, right? So the expected utility with no insurance is 9.3. Now with insurance, right, in fact with full insurance, we know that if there is no accident, they'll have their $12,000. They'll pay a $360 premium, and so they'll have a consumption level of 11,640. So we have a utility of log of 11,640. We multiply that by a 99% probability. We know in the case of an accident, which arises with a 1% chance, they'll have their car, their $12,000 car, wiped out. It'll be totaled, right? But they'll get a payout from the insurance company of $12,000. But what do they always have to pay? The premium. The way we do these problems, you always pay the premium. So they'll have a utility of log of 11,640. So the utility level in the case of full insurance is 9.4. So what is our snail whose utility function follows log consumption going to do? Buy insurance or not buy insurance? They'll compare the utility levels and go with what? Buy insurance, exactly, buy insurance. Because in this case, those snails are sufficiently risk averse that they want to purchase insurance even at a price that is 3 times the actuarially fair price. Because what we're saying is that the marginal utility gain from transferring $1 from the good state to the bad state is so high because their utility function is so curved that they're willing to pay 3 times the actuarially fair price in order to make that in order to buy full insurance. This is what we call a pooling equilibrium, right? Because the low risk type knows that the premium is high compared to their risk, but they're willing to jump into the pool with the high risk type anyway. They're going to pool and all buy insurance at $360. Everyone is insured. What will happen to the insurance company? They'll break even on average, right? They'll break even on average. Everyone see why that is? Because the premium is averaged between the two of them and everyone's willing to purchase. It'll all work out. It's a pooling equilibrium. Okay, now let's consider a different case. Let's imagine a snail population that is less risk averse. Their utility functions follow the form u of c equals c to the 1/2, or square root of c. What's their expected utility here with and without insurance? Okay, let's take a look at it. Okay, so here we have a utility function of the form u equals c to the 1/2. We know the expected utility without insurance is going to be a weighted average of utilities in the two states, weighted by the probabilities. So utility, if there is no accident, is 12,000 to the 1/2. There's a 99% chance that happens. In this case, if they have an accident without insurance, their consumption falls to 0, and their utility is 0 to the 1/2, also known as 0. We multiply that by 0.01. So that the expected utility when there is no insurance and they face the full gamble is 0. In the case of full insurance at a $360 premium, we know that their utility level when there is no accident will be 11,640 to the 1/2. And if there is an accident, again, their utility level will be 11,640 to the 1/2. And their utility level will be 107.9. In this case, would the snails opt to buy insurance or not? No, because they're better off with no insurance, right? Because their utility function doesn't have enough curvature that the marginal utility gain from transferring money between the two states of the world through insurance is worth it. They're not risk averse enough to want to buy insurance at a price of $360 for full insurance. At the average price, they opt not to pay for insurance and opt out of the insurance market. And there is a market failure. They separate. They choose to do something different than the high-risk types, than the racers. And there is a market failure. Because the snails aren't risk-averse enough to want to pay $360 for insurance, but they are risk-averse, right? Their utility functions do have some curvature to them. They are risk-averse, and they would like to buy full insurance. They just want to pay the actuarially fair price or something closer to the actuarially fair price in order to buy it. And here they're opting to separate, and there's a market failure. They're uninsured. Okay, I want to point out one thing. What were the numbers we were looking at in this case? They're like 105, 108, right? What were the numbers like in this case? They're like 9.4. So when we talk about utility, we can make comparisons within the function, right? Are you better with this gamble or that gamble? But there's no information. When I tell you this person has a utility level of 9.4, that tells you very little about how happy they are, right? And that's because this is the way utility is, right? It's ordinal, right? It has like it's comparisons across these numbers make sense. You can't compare the 107.9 to the 9.4, right? Right. We can make these comparisons between 9.3 and 9.4 within the same type of utility function, but across utility functions, we're going to have different types of numbers. The assumptions matter here. Okay, let's go back to our separate equilibrium. So in this case, right, because of adverse selection in the insurance market, the insurance company charges a premium that's average for the population, right, and the low-risk type chooses to not buy insurance. It chooses to separate, and we have a market failure. Well, what would actually happen in this case? So who's going to buy insurance? The racers and the racers alone. So what's going to happen to the insurance company? They'll lose money because they're charging these racers $360, and 5% of them are getting into accidents, right? They're going to lose money. Let's imagine this insurance company actually had enough cash to sort of survive this for 1 year. And they wake up and they realize, you know what? These guys cost us a heck of a lot more, right? So then they're going to price at $600. They'll get it right, and they'll only be insuring the high-risk type, right? Only the racers will be insured. And they'll be insured at their actuarially fair price, and the world is good. Now I want you to do a thought experiment with me. Let's imagine, so here we have two types, right? We have a low-risk type and a high-risk type. And instead of that, imagine we have 1,000 people in the population, and we order them, and each one is slightly more risky than the last. So there's the low-risk guy, the highest-risk guy, and everyone is in between. Okay, so there's a continuum of risk types. So imagine at first, the insurance company decides to charge the average premium, the average actuarially fair premium across this population. Let's imagine these guys are like our not so risk-averse snails, right? Everyone is. Who's going to opt out? Everyone to the left, right? All the lower, I guess I should do this for you guys from your perspective. So imagine the high-risk types are over here, the low-risk types are over here. We divide it in half. Everyone from here over is going to opt out and separate and not buy insurance. The insurance company will have charged this premium. What will happen to them at the end of the year? They will have lost money. What are they going to do in reaction? Raise the premium. What's going to happen? The next lowest risk types are going to drop out, right? And they're going to raise the premiums. We call that a death spiral. That combination of the population of insurees, the people buying insurance being adversely selected, their insurance company reacting by raising premiums, which leads to what? More adverse selection, which leads to what? Even higher premiums, more adverse selection, until who is the only person who's insured? The highest risk type, right? And that's what we call a death spiral, a death spiral. Remember, in this example, we've always talked about an insurance market that's perfectly competitive, so that insurance companies are charging the actuarially fair price. Can insurance companies really charge the actuarially fair price? No, because I mean, running an insurance company costs money, right? You have to pay the guy who writes the policies, you have administrators, you have to pay rent, you have marketing. There are costs to running an insurance company. So typically insurance can't be sold at the actuarially fair price because of overhead. And if the market is somehow not competitive, right? If there is monopoly power, you could see monopoly pricing of insurance too. But so far we've talked about actuarially fair pricing as sort of the baseline starting point. Okay, so this is all of this, the separate equilibrium, is the result of adverse selection, which arises from the combination of heterogeneous risk types, people having different risks, and asymmetric information between the insurees and the insurance company. Okay, that's in our example. More generally, separate equilibria, we see them more often, right? We see both non-insurance, so people not buying insurance because of market failure. We also see underinsurance, because insurance companies often offer different kinds of insurance products to get people to reveal their type. What's something we often see with insurance companies? You pay a lower premium in exchange for paying a higher deductible, right? Because who is more likely to want that kind of contract? The low risk type, right? So an insurance company offers different kinds of insurance contracts that are really more and less insurance, right? Because when you have a high deductible, are you as fully insured? No, because you're liable for that deductible in the case of the bad event. So they offer insurance contracts that offer less than full insurance, knowing that the types will take that up are the low risk type, and they can then price the high risk type appropriately, right? So in order to get people to reveal their types, insurance companies offer different types of insurance contracts. We see this in healthcare, right? HMOs are generally less insurance. They're less generous insurance. Is that what someone who has, heart conditions and cancers and all this stuff, are they going to want an HMO? No, if they can afford it, they're going to want platinum coverage, right? More insurance. HMOs are typically taken up by people who have modest medical expenses, right? What the insurance company would call the low risk type. So that's something we see in HMOs. But with these types of contracts, whether it's the HMO or the high deductible insurance policy, all of this is still a market failure because we think most people are risk averse. Almost everyone has some risk aversion. They'd like to insure themselves against healthcare expenditures, against expenditures arising from an auto accident. But because they can't get actuarially fairly priced insurance for their risk type, they end up doing with less insurance. This is a market failure. This sort of system by which insurance companies offer different contracts to get people to reveal their type is inefficient. It leads to some people being underinsured, and it's a market failure. So are there public policy solutions to this problem? Right? We've said that the private market here there are market failures in insurance markets, is what we've established so far. They arise from heterogeneous risk types and asymmetric information, right? And so the question is, if the private market isn't doing it so well on its own, is there a role for government? What can government do if it tried to act here? Well, market failure due to adverse selection, right? What's really happening? What does adverse selection lead to in the market failure case? Separating equilibria, right? It's because the low risk types opt out of the insurance market because it doesn't price fairly for them. So how do we get people to pool? We can force them to pool, right? We can have what's known as a mandate. You must go buy insurance, low risk types. We tell the low risk types, I'm sure you don't want to buy insurance at what they're charging you, but guess what? You're going to buy insurance. We're going to force you to pool with the high risk type. We correct the market failure by fixing the quantity of insurance, right? We force everyone to buy insurance. We end the market failure, but there's a transfer involved, right? Because we'll get there in a second. So there's two ways. We can do a mandate, right, where we tell people go out and buy private insurance. I grew up in California. We've had this for cars for a very long time. In order to register your car in the state of California, you must show proof of insurance. This is true for other states as well. So that is requiring individuals to go out to the private market, to go to State Farm, to go to Farmers, to go to Progressive, to go to whoever, and buy insurance in the private market. That's one way the government can force a pooling equilibrium. The other way the government can force a pooling equilibrium on the low-risk types is by social insurance. There's no opting out. You're taxed, and then you're in the program. An example of this would be Social Security or Medicare, right? You pay tax revenues, you pay payroll taxes, you're insured against outliving your savings in the case of Social Security. You pay Medicare taxes, you're insured against high healthcare costs in old age. Tax and put people into the program. That's the other way government can do this, through social insurance programs. One relies on the private market, the other has a government-run insurance program. In both of these cases, what you're really doing is forcing the low-risk type to pool. In other words, not letting them drop out. Because why was the low-risk type choosing to not buy insurance? Because the utility was higher from not buying insurance than buying insurance, right? Because of the price of insurance. So whether the government forces the pooling equilibrium through the private market, through mandates, or by actually creating a social insurance program, in both of these cases, there is redistribution. The low-risk types are made worse off, right? Because they would on their own opt to not buy insurance at these prices. And there's a transfer from the low-risk type to the high-risk type, right? Because they're going to cross-subsidize. In the case of the mandate, depending on how insurance is priced, you could also have transfers from the low-risk type and even the high-risk type to the insurance companies, right? Or to the government, if government's overcharging people for their insurance, right? So there's also that side of it too. Okay. When we think about social insurance and whether or not we should have a social insurance scheme, the justification for social insurance really hinges on three factors. The first is, are individuals able to consumption smooth without the social insurance program? Right? Because the big benefit of insurance is what? It allows people to smooth utility between good and bad states of the world. Right? That's what insurance really lets people do. There's a consumption smoothing benefit to it. But a social insurance program is only valuable if it's increasing the ability of individuals to consumption smooth. If it's simply replacing the consumption smoothing they were doing anyway, there isn't a lot of value to that in social insurance program, right? It's only added consumption smoothing benefits that matter. Individuals could have been smoothing consumption privately. For example, they could have been purchasing market insurance, right? Do we see a big justification for social insurance programs for auto insurance? No, right? I mean, we force people to buy it in some states, but we think that auto insurance markets work relatively well, and that people are sort of able to go to the private market and insure themselves against car accident losses, right? So individuals could be smoothing consumption privately through private insurance markets. But there's also something we call self-insurance, which is ways individuals act in order to smooth consumption between good and bad states of the world that only involve their own finances. There's no insurance contract. Self-insurance. It's ways they protect themselves against losses if bad events occur. One way we do this is simply saving, right? This is like Susie Orman's dictum. To always have 6 months worth of expenses in your bank account, right? That's saving against a bad event like unemployment or something. If you lose your job, you have your savings to rely on. That is simply saving to smooth consumption in a bad state of the world. You could do the same for something like medical expenses, right? You save assets in order to pay for medical care if your kid breaks his arm, or if you get into an accident of some kind. So there's savings. There's also borrowing, right? You could go to a bank and get a loan. Banks aren't really thrilled about lending to people who are in bad states of the world, right? You lose your job, Bank of America isn't inviting you in, right? So borrowing through private capital markets is less available for individuals, but one could do it through bank lending and such. This is a big one. Increased labor supply of family members. So if one person loses a job, their spouse goes to work or works more shifts, right? It's consumption smoothing by sort of reallocating labor supply within the household. That's another way people consumption smooth in bad states of the world. If you lose your job, if there are added expenditures from bad events occurring, from accidents, from injuries, et cetera, you could increase labor supply from family members. And finally, there's borrowing and transfers from friends and extended family, right? That's sort of the kids going home and living in their parents' basements, right? That's sort of it's intra-family lending and borrowing. Actually, it's interesting. There's some work I know some of you are interested in development work. This is actually a really interesting part of development right now, is to sort of study how people in what we think of as the developing world actually have, not exactly contract insurance, right? It's not like there's an insurer in the village, but there are these informal insurance mechanisms that sort of smooth consumption among households. When one household has a bad shock and has a bad harvest, there are sort of mechanisms that seem to actually be in place to sort of lend and borrow within the community in order to smooth consumption across bad states of the world for individuals. Of course, you can't insure against village-wide shocks, negative shocks, right? If the whole village has a bad harvest, that kind of informal insurance may not work so well. But if it's idiosyncratic risk, one farmer has a bad harvest, other farmers can help him in those circumstances through informal insurance, it seems like. And it's a super interesting line of research, I think. Okay, so we said the importance of having a social insurance program depends on, really, are we crowding out existing insurance mechanisms? Or are we really offering people more ability to smooth consumption across states of the world? Second, whether or not we need a social insurance program depends on the predictability of the event. Do we really? So if a couple is going to have a child next year, is that really an event we insure them against? If they plan to do it? No, I mean, if many jobs don't come with paid maternity benefits, right? So if a woman is going to opt to leave the workforce for a while when she has a baby, self-insurance seems like a good way to go, right? That's not really an event we insure people against. Most people who have children, it's a predicted event, right? I mean, in the case of that's different, but So lots of things are predictable. Those are things you don't need insurance against. You don't need insurance for your annual physical, right? That's a highly predictable event. What's unpredictable is a catastrophic illness, right? It's hard for you to predict that you would develop a type of cancer that's very, very expensive to treat, right? That's hard to predict. It's hard to predict that you could suffer a catastrophic accident on the job, right? Those are unpredictable events, and the more unpredictable the event, the more social insurance makes sense. Because the efficiency of private insurance for those kinds of, self-insurance for those kinds of risks is not so clear. Third, the cost of the event. If the cost of the event is minor, like an annual physical, we feel like people can save for that, right? They can rely on borrowing from friends and family. They can rely on extra labor supply from a spouse in the case of small costs. Your kid breaks his arm, maybe that's doable. Your kid is diagnosed with leukemia, added labor supply from your spouse may not really cover those costs, right? So it's the magnitude of the cost and the predictability of the cost that really determine whether or not social insurance is needed. Let me give you an example. Imagine, we all run some risk of having incredibly high medical costs, right? Especially in old age. Some elderly people encounter multiple very expensive diseases, right? They both have heart disease and are diagnosed with cancer. And that could, exceed $1 million in medical care costs, right? Imagine you make, $80,000 a year. For you to save for that cataclysmic event, for the event that you need that much medical care in your old age, would require significant sacrifice through your lifetime, right? You would have to forego a lot of consumption in order to self-insure against that risk. And that event of that kind of medical expenditure coming your way is very low, right? It's a pretty low probability. So you could actually sacrifice a tremendous amount of consumption through your lifetime to insure yourself against a risk that is nearly zero chance of happening, right? That would be really inefficient for you to give up that much consumption to protect yourself against a risk that's that low. What would be better is for you and everyone you know to set aside some money, right? And in the case that this terrible event happened to any of you, there would be funds to pay for that. That is insurance, right? It's pooling your risks among a group of people in order to sort of not have to sacrifice your own consumption path to the same degree. And that's insurance. And social insurance might make more sense for those kinds of expenses, right? For very large expenses that are difficult to predict. That justifies social insurance. Questions about that? Or anything we've done so far? Okay. Let's go on to moral hazard. So I really want you guys to completely understand the difference between adverse selection and moral hazard. They're not even really that related, but somehow they can get confusing on exams. So we've talked so far about adverse selection. Adverse selection means asymmetric information and different risk types lead insurers to believe that the people coming to seek insurance are higher risk than the population as a whole. That's adverse selection. Now we'll talk about moral hazard. Moral hazard is about the fact that when you're insured, you behave differently. The fact that you have insurance against the bad state of the world changes the way you act. That's moral hazard. So moral hazard is basically inefficient behavior encouraged by being insured against the adverse event. Moral hazard can take several forms. For example, you may have reduced precaution against entering the adverse state. You may be a more reckless driver if you know you have car insurance. You may not be as careful about your diabetes if you know you have health insurance. Second, you may pretend to be in the adverse state. We also call that moral hazard. You were not really injured on the job, but you're going to try to claim workers' comp anyway. You're going to pretend to be in the adverse state of being injured on the job. Third, you could have increased expenditures in the adverse state. If you had, let's say you hurt yourself at home, you may have waited to get that MRI, right? But if you get injured on the job and it's covered by workers' comp, you're all for getting that MRI, right? It's increased expenditures in the adverse state because you're insured. That's a big worry when it comes to healthcare, right? We feel like people don't face the full cost of, when there's a decision about whether to have a Chem 20 or a Chem 9 blood test, they don't feel the price difference really, right? So expenditures are higher when they're sick. That's a form of moral hazard. And finally, we also, the first three, right? These three were about the insuree behaving differently. The person who's insured changing their behavior because they're insured. The last margin we're going to talk about is supplier response to insurance, right? That kind of is more like when you go in to see your doctor, he or she, because they really are, it's not that they're evil, but they are thinking about you and your finances, right? They might ask you, are you insured, right? And you say yes, and they're like, yes, let's get that MRI then. It's not that they're trying to bilk your insurance company necessarily, but they're thinking, what, if you're going to pay the $800 for this MRI, maybe we wait a week and see how you're feeling, but if your insurance company's going to pay for it, we might as well do it now, right? That may be, that's the supplier response to the fact that you're insured. Okay, so moral hazard can also prevent markets from providing insurance because it's difficult for the insurer to understand exactly what your expenses will be because you're going to change your behavior. It can prevent insurance markets from functioning well. Social insurance can't eliminate moral hazard. Moral hazard is a function of being insured. It doesn't matter whether that insurer is a private insurance company or the government. Moral hazard is simply a difference in your behavior arising from the fact you're insured against the bad event. Social insurance can't solve this one. It may, in fact, exacerbate it. So moral hazard is most likely to occur when it's easy to change your behavior to establish the adverse event, when it's easy to sort of claim the adverse event. Second, when information is highly asymmetric, when it's difficult to verify that the bad event has actually occurred, moral hazard is more likely. For example, one of the kinds of on-the-job injuries people face, or do suffer, is something that we often call chronic back pain, right? And chronic back pain can be very real and very painful and not apparent on x-rays or MRIs, right? Someone can be suffering a great deal and it's just sort of not very visible with the types of medical tests that we have. A case like that, like I said, someone who's really suffering from it will look sort of asymptomatic when it comes to tests and results. That's a difficult to verify state, right? It's difficult to verify someone is suffering from chronic back pain. So whether someone is or is not actually suffering from chronic back pain is not actually informed by looking at any test. That's a difficult to verify adverse state, and it's sort of easy enough to change your behavior. Because what do? You claim you have back pain, right? That would be an example of where moral hazard is more likely to occur than in other examples. I think your book probably talks about the example of the town in Florida with where people, I think they call it Stumpsville. Yeah, there's a documentary about it. I think it's by Errol Morris, I think, where people really wanted to claim DI, and they actually went, moral hazard is not easy when it comes to limb loss, but they were willing to actually undertake that type of moral hazard. They removed their own limbs to claim DI. But so moral hazard is more likely to occur when it's easy to establish the behavior and it's difficult to verify the adverse state, but apparently can occur in other situations as well. Why am I all negative about moral hazard? Why do I look anxious and worried about moral hazard? Because moral hazard is deadweight loss. It is deadweight loss. It's distorting behaviors, right? You're going to change your labor supply. You're going to leave the workforce because you're pretending to be disabled and go on DI. It's reducing savings potentially if you were self-insured and insurance is leading you to save less. It's changing your consumption of health care. Right, so if insurance is leading you to spend more on healthcare than your preferences really dictate, it means that you're consuming healthcare units that are worth less to you in terms of utility than what they cost to produce. You're only willing to consume them because you're not paying for them, right? That's a waste of resources. That is deadweight loss. And second, all of this moral hazard makes social insurance programs cost more. And when programs cost more, how do we pay for them? Right now we ask the Chinese to lend us money. But how do we eventually pay for them? Taxes. And what do taxes cause? Deadweight loss. Moral hazard is deadweight loss. And in Stumpsville, there's real deadweight loss, right? People have done horrible things to themselves because of moral hazard, right? It's a two-way stream. It's a double whammy of deadweight loss.
Stumpsville seems to be an extreme outlier
Yes, I mean, come on. I mean, of course, yeah, right. I mean, that's why it's notable in your textbook, right? But dead weight loss is also caused by going to the doctor and getting the Chem 20 blood test rather than a Chem 9, right? Because if you were paying for that blood test and you would opt for the Chem 9, sorry, that's just the number of things they test for. If your preferences would dictate, you know what, I only care about these 9 tests, let's do those, I'll pay for those. But because your insurance company is covering it, because you're paying a premium, you're paying for everything you consume on average, right? Because you're paying the premium. But when the decision comes to go for the Chem 9 or the Chem 20, it makes no cost difference to you, or it makes a very small cost difference to you if you have some copay. It means that you are opting to consume more medical care than you really value at what it costs, right? You wouldn't pay for the Chem 20. I'm saying, for example, if you wouldn't pay for the Chem 20, you'd only pay for the Chem 9 if you had to pay the cost of these 2 things. But you're willing to go for the Chem 20 because your insurance company pays for it in that moment. That's dead weight loss. Because doing those extra 11 tests costs society money. There's the lab tech, there's the vials, there's even the discomfort to you of losing blood, right? There's all this cost, and you wouldn't be willing to pay for those costs if you actually face the price. That's dead weight loss. It's that, you remember the dead weight loss is all those units where the supply curve, right? You don't value it enough. That's dead weight loss, right? It's overconsumption. It's the triangle that's this way, where the cost curve lies above the demand curve. It's a this way dead weight loss triangle. It's overconsumption. Yeah, there's dead weight loss. That's why we worry about moral hazard. Okay, so what have we learned so far? We've gone very slowly, and I'm very happy to go slowly. If you have any questions about this stuff, please ask me now. Let's get everyone on the boat as it's going, right? Right now we have plenty of lifeboats. We can come get you if you're lost. It gets harder and harder to do as we go on. So what have we learned so far? If any of this seems mysterious, let's stop. So we've learned that individuals value insurance because they're risk averse and would ideally like to smooth consumption and purchase full insurance. If they can get it at an actuarially fair price, they would all buy full insurance because we assume everyone is somewhat risk averse. Insurance markets may fail to emerge or may fail to provide full insurance because of adverse selection and because of moral hazard. Expanding social insurance encourages moral hazard. Expanding any insurance encourages moral hazard. Social insurance is no different than other insurance. To the extent that private consumption smoothing mechanisms are available, we talked about saving, we talked about increased labor supply within the household, we talked about borrowing. To the degree that private consumption smoothing mechanisms are available, we have to examine whether social insurance programs are adding new consumption smoothing or simply crowding out consumption smoothing that was happening anyway. Okay, question.
Is moral hazard and asymmetric information similar? Because in a moral hazard also you tend to give wrong information.
When we talk about moral hazard, when we talk about, you're trying to establish that the adverse state occurred, right? That type of moral hazard where you're trying to claim that you were injured and you weren't. It's not really, you know the truth. There is asymmetry, but it's more that it's hard to verify, right? It's more that. Other questions? Yeah.
Is there a whole way that all economists look at insurance? Because it seems like, it's assuming a certain level of intentionality of someone who is going to save for the future if they know the future costs X. And the reality is nobody is really prepared to think that way.
Right. So this is the canonical neoclassical economics model, where we assume that the agent is perfectly rational, perfectly informed. And when we talk about real social insurance programs, one of the many there's many motivations, but one real motivation for many social insurance programs, for example, Social Security or Medicare, is that there's paternalism. We think people aren't saving for retirement as they should. We can't look at it today everyone has Social Security, but even before that, we fear that people just don't really, they either don't know how much they have to save, or they're unable to commit to, they know that they have to save, but they can't commit to it, or that, there's just, in Social Security is paternalism combined with also redistribution, that some people, their income level may prevent them from really saving for retirement because their income isn't sufficient for there to be extra, for there to be savings because they're barely meeting their expenses. all of this is part of the motivation for social insurance. And when we talk about real programs in a minute, we'll talk about that stuff too. Other questions? Yeah, Tal.
So maybe I got a little confused. When you talked about the death rate loss,
Yep.
so you said that for private insurance, the higher premiums make people
Right, sorry.
not buy insurance.
Yeah, so this is about why social insurance might actually make moral hazard worse than private insurance will, is because it's just we think when private insurance companies sense that there's moral hazard going on, people are spending more money than they thought they would, they just change premiums, right? They'll offer different insurance contracts. Private companies are probably more nimble and also are more free to do things like that, to offer different contracts, to increase premiums, while this isn't necessarily the socialness of the system, it's just sort of the way things tend to work, is that, if we sense there's a lot of moral hazard, say in Medicare, we don't necessarily increase tax rates next year to pay for it. So for private insurance, the higher premiums induced by moral hazard deter some people from purchasing insurance. You could imagine, so suppose the high risk types are also really moral hazardy. The low risk types will be even more excluded, right? Because then insurance companies they have to charge high premiums because they know they have adverse selection. Plus these high risk guys are gonna go spend a bundle. So they're gonna jack up premiums even more of the low risk types will opt out, and there'll be more market failure in that case.
So why did you say it is overconsumption?
Not of insurance, of medical care.
Oh.
It's not overconsumption of insurance. It's of the expenditures in the bad state. Yeah. Question over here? Yeah, David.
There's also a moral hazard where the insurance company has in their incentive to provide less service because it saves them.
That's contract they're reneging on their contract, right? That's like that's what you're saying, right? That they sold you a contract where you thought you were covered for all of these things, and it turns out they're trying to claim that you didn't submit this form. Did you have to go to this specialist? That's what you're talking about? Or they're trying to deny claims down the line. They're saying like this. That's sort of
It's in their interest to provide less service.
Well, that could be two things. It could be trying to combat moral hazard, right? That we had this contract, you're spending way more than anyone thought you were, right? But it could also be they're trying to renege on their contract. They're trying to provide less insurance. They're trying to make profit. That's another danger, right? And that requires the enforcement of contracts. That's not really a failure of insurance, it's the failure of the enforcement of the contract. If you're not getting the insurance that you thought you paid for, either you didn't understand your contract or the insurance company is reneging on it.
And these insurance companies, they're generally very profitable.
Right, so that's what we talked about before when we talked about there could be less, the insurance market may be not perfectly competitive. There might be pricing power, right? And also, remember, when you call profit is not what we call profit in economics. You're talking about accounting profits. Those are also, profits that go to sort of, funding the business. If they're extremely profitable, some of those accounting profits are also economic profits. But, accounting profits are not all economic profits. We're talking about rent when we talk about profits.
I'm talking about the profits that make the valuations of these companies being in the
That's accounting profits.
multiple
So
billions of dollars.
I'm gonna have to. So you're talking about accounting profits, and that's not the same as economic profit, right? There can be accounting profits without there being rents, so those factors of production are being paid their opportunity cost in other uses, and there can still be accounting profits. We can talk more about this after class, but we just have to keep going because we have a whole other lecture today. Questions about the material? Yep.
Did you say that private insurance encourages more moral hazard?
No, we said that all insurance encourages moral hazard. Private insurance companies might be better at increasing premiums to cover the moral hazard, right? And so you're sort of paying for your own moral hazard maybe more. Governments tend not to increase tax rates by expenditure type as much, right? And so it could be that sort of moral hazard might be worse in social insurance, but you should think of moral hazard as a consequence of all insurance. The fact that you're insured changes your behavior, and that's moral hazard. Does that make sense?
So, on the next slide, why did you kind of just say social insurance and
So that's what we're talking about. It's all insurance, but we don't expand insurance, right? We don't expand private insurance. There's no collective decision to expand insurance markets. So we're just talking about when we expand social insurance because that's a policy choice, right? It's expanding social insurance. And when we increase insurance, yes, we increase moral hazard. But that's not like, we don't ask State Farm to increase insurance, right? Like, that's not a decision we make. But this is a policy lever. If we increase social insurance programs, we're going to increase moral hazard. Does that make sense? Okay, great. Other questions? These are all good questions. And again, I'm willing to sacrifice talking about the details of workers' comp to get through this stuff. This is more important. Okay. Optimal social insurance. So we think of insurance or social insurance as having the benefit, offering the potential benefit of added consumption smoothing, right? Above and beyond what people are able to do through private insurance markets or through self-insurance. So there's the benefit of added consumption smoothing versus the cost of triggering moral hazard, right? That's the sort of the negative of social insurance. So when we think about the optimal level of social insurance, we're going to trade these two things off against each other. We have to balance the cost of the moral hazard triggered by social insurance programs or by the expansion of social insurance programs against the benefit of sort of letting people smooth consumption between good and bad states of the world better through social insurance program. And that's what the optimal social insurance level is about. It's about trading these two things off against each other. Because of moral hazard, social insurance programs should be less than full insurance, right? Because when we talk about full insurance as having this great utility benefit from consumption smoothing, we didn't consider the fact that it triggers moral hazard. Full insurance would be great, but moral hazard is a problem. So we're going to have partial insurance in social insurance programs. And that's what we see, right? We don't have Social Security insurance that replaces 100% of your wages from your pre-retirement years, right? Unless you're very poor, as a Medicare recipient, you still have copays, right? It's partial insurance. It's partial insurance. And that's because of moral hazard. If there's more moral hazard in a market, we should see less insurance in that market. More partial insurance, less complete insurance in that market. If we trigger a lot of moral hazard when it comes to medical care, we should see less complete coverage. And social insurance should be more generous for events that are hard to predict and are long-term, right? They're high cost, and there's less ability to sort of privately save or privately consumption smooth for them. Okay. That's the end of this one. Let's move on to lecture 11. Okay, social insurance programs. We're going to get into some details. So first we're going to talk about Social Security, and then we're going to talk about social insurance programs in the labor market, which are workers' comp, disability insurance, and UI, unemployment insurance. Okay, so we already talked about optimal social insurance. So again, because market failure arises in insurance markets due to adverse selection and moral hazard, there's a role for social insurance, but an optimal social insurance program trades off the moral hazard consequences against the consumption smoothing benefits of having more insurance. There you go, sure. Anyone else need slides? Okay, so that's the optimal social insurance level. Let's talk about the nitty-gritty of Social Security. So why do we have social insurance in general? Let's back up 1 second. So this goes back to, I'm sorry, Christina? Catherine? No, neither of those is your name. I'm sorry. Yeah. Sorry. I think this is like the 4th time I've asked you your name. I'm sorry. Do you wear your hair differently sometimes? I mean, yes, I'm sorry. I'm like, there's got to be a reason why I can't identify you. Sorry. Anyway, okay. Rationales for social insurance. Well, markets fail, right? We've talked about for a long time that insurance markets face market failure. Due to asymmetric information and adverse selection, there is an underprovision of insurance. Some people aren't fully insured, some people are not insured at all. That market failure justifies a rule for social insurance. Second, externalities. The failure of some people to have health insurance leads them to not be vaccinated, which increases my risk of getting some terrible disease. So there's externalities to some insurance markets, and that's a justification for social insurance. There's redistribution, right? Social insurance is a way we redistribute from low-risk types to high-risk types. If we feel like being born a high-risk type is just an unfortunate event for you, that it's not that you race around driving really fast, you're more likely to get into a car accident, but there's something sort of, unlucky. You're unlucky and you're born a high-risk type. We sort of want to subsidize that fact through redistribution via social insurance. If you have a genetic condition that makes you more likely to have very high medical expenditures, we may want to redistribute towards you. And one way we can do that is through social insurance programs. As Amira brought up, there's paternalism. That is the fact that, sure, if you were a rational, neoclassical economics agent, you would handle this decision well. You would commit yourself to a savings program, and you would save according to that savings program, and you'd invest it in a diversified portfolio, and everything would be fine. But we don't always think everyone is able to do that. I mean, many of us have trouble making decisions like this. And so it's simple paternalism. We think people don't save enough for retirement. We don't think they save enough for healthcare costs in old age. It could also be that, these things could be really hard to predict, right? It could have been very hard for someone who is now 80 to have any idea how expensive healthcare would be when they were 80 years old, right? We've had so much medical innovation. For them to understand the probability distribution of healthcare expenditures 50 years from now, that's a lot to ask the average person to do. Simple paternalism, or just sort of, the future is very uncertain, we want to offer people insurance against it. And the last justification is pure administrative cost. So private insurance companies may be less administratively efficient than the government for a couple of reasons. First of all, there is the profit motive, right? So there's some load on insurance premiums that is just due to sort of pricing. And second, there could just be economies of scale, right? The more insurees you have, the lower the administrative cost per insuree. And so it might make sense to not have 1,000 different insurance companies, but have the government just run the program. There could be administrative cost justifications. And that's very true in the case of Social Security. The administrative costs of Social Security are incredibly low. They're very, very low. Okay, so how does Social Security work? Well, there's a 12.4% tax levied on wages and salaries up to an annual maximum. That maximum for 2012 should have been $110,100. The payroll tax holiday makes things a little complicated, but let's just say that's what it was. So all wages up to $110,100 are taxed at a 12.4% rate. After that, there's no Social Security tax. The 12.4% rate is levied statutorily equally between employer and employee. So the employer pays 6.2% of what he pays you. You pay 6.2% of what you make, up to $110,000. Does that mean the employer pays half the tax in terms of incidence, economic incidence? No. What determines who pays the Social Security tax? Elasticities, exactly. And what do we guess? Who do we think is the relatively more elastic side here? The employer. So who do we think pays Social Security taxes? Workers. Employees. Workers pay Social Security taxes. The benefits. Okay, so there's a big section of your book that talks about how the benefits are calculated. I want you to understand them conceptually, and we'll talk about it today. I am never going to ask you to calculate someone's PIA, given their AIME, their average index monthly earnings, their primary insurance amount, their full benefits age, their early entitlement age. These are, you should read them, you should understand all of this, but that's really not conceptual enough for an exam I would give you, right? The kinds of things I would ask you to know, I will talk about a little bit. So benefits, there's a benefit calculation system. Basically, the way to think about it is that the more, you get a higher Social Security benefit, the more you earned, up to a certain level, and then your insurance, and then you don't get any more benefits for earning more. And the rate at which your Social Security benefits increase as you earn more slows the more you earn. We'll talk about the structure of that in a second. There's a full benefits age, at which point in time you're entitled to basically your entire primary insurance amount. If you choose to retire early, roughly 62 right now, i.e. start getting benefits at your early entitlement age, you'll get less than your primary insurance amount. You get a little bit less because you're going to get benefits for longer. All of this getting less, getting more, all of this is actuarially fair. Based on a person born year, the government has a lifetime table. They know roughly how long you're expected to live on average. So for an average person of your birth year, it's actuarially fair. The government isn't taking from you or giving to you. If you get benefits early, you're going to get benefits. You're going to be paid benefits for longer, and they're going to reduce the benefits by the commensurate amount, given that you're going to get them longer for the average person born your year for their lifetime. If someone who's going to live longer or shorter, taking early retirement benefits might make more or less sense, right? Right. So if you decide to wait longer than your full benefits age and wait later than on average 65, it's higher than 65 now, but let's just call it 65, you will get more on average per period in benefits because you're going to get them for less time, right? So it's all actuarially fair. And benefits are indexed to adjust for the cost of living. There are also survivor benefits, so if the primary insuree, the person who paid into the system, passes away, then his survivor, his spouse or his minor children will receive benefits. There's redistribution. in replacement rates, so your replacement rate, the ratio of your sort of Social Security benefits to your earnings during your working lifetime, is a higher ratio the less you earned, as long as you earned enough. As long as you met the minimum, the less you earn, the higher your replacement rate. And finally, one way we talk about redistribution, the way we sort of measure the generosity of Social Security for different individuals, is we calculate what we call their Social Security wealth, which is nothing but the present discounted value of all the benefits they'll be paid, less all the taxes they paid in. Right? It's sort of the net gain or loss you face from being part of Social Security. It is your Social Security wealth. Okay, first let's talk about how the benefit formula works. So you have your AIME, your average index monthly earnings, which is sort of your average earnings during the best 40 quarters of your working career, right? How do they choose the number of quarters to count? Well, you don't want to count them all, right? You don't want to count every quarter someone worked, because you're sort of punishing someone who maybe started off in a low-paid job in order to pay for their education or whatever it was. They were starting out at a low-wage job. You don't want to penalize them, right, for that. At the same time, you don't want to pick someone's best year, right, because that's largely unrepresentative of all the taxes they paid in. So you're going to pick something in the middle, and we've sort of picked this number of quarters. So that's your average indexed monthly earnings, right? It's roughly your average earnings during some number of quarters of your life is what I want you to know about that. That's sort of what you made. Your primary insurance amount, which is sort of your baseline Social Security benefit, at first increases pretty rapidly with every dollar of monthly earnings you had, up to $711. Then your PIA, or your benefits, increase more slowly, right, for the next interval, up to $4,228. And then up to roughly $6,300, your Social Security benefits only increase by 15 cents for every additional dollar you made. After $6,300 per month of earnings during your working time, you get no more benefits. So someone who made $10,000 a month versus $6,300 a month gets the same Social Security benefit. You cap out. You max out your benefit, and that's the benefit you get. That's why replacement rates are higher, right, for people down here, because a much higher fraction of their AIME is translating into benefits, right? The ratio of PIA to AIME will be a higher fraction for people to the left on this axis, right? Does everyone see that? So there's a progressivity to the way benefits are calculated. Yes, question? Roughly $6,300. I mean, it's probably something higher than that now. There's been inflation, but it's it's not low. It's not terribly high. Yeah, sure. Other questions? Okay. So what I would require you to know is to know that this is the way this is structured, that there are higher replacement rates for people with less income, right? You wouldn't need to know that it's roughly $6,300. That's not something I'd expect you to know. I would expect you to know that it's concave, that the slope gets flatter as you earn more. Okay, Social Security wealth. As I said, your Social Security wealth is just a measure of how good a deal Social Security is for you. It is the difference between the PDV, the present discounted value of all the benefits you'll get from Social Security, less the PDV of all the taxes you'll pay into Social Security. Social Security wealth is lower for younger generations. And that's because older generations, so in the 80s, we increased Social Security tax rates a lot. And older people paid some of their taxes or more of their taxes at the lower rate time period, in the lower rate time period, but they're getting benefits commensurate with the higher rates of today, right? So they have a better deal because they're getting high benefits and some of the taxes they paid were at pretty low rates. So younger generations have less Social Security wealth. Higher earners have less Social Security wealth, right? Because we said that benefits sort of are maxed out at less than $7,000 a month, right? $7,000 a month is roughly what, $84,000 a year, right? Is that right? I can't do basic math up here. That's right, 84,000, right? Someone help me? Yeah, someone nod. 7 times 12 is 84. Yes. Okay. Good. So that's roughly $84,000 a year, but you pay taxes up to $110,000 a year, right? So the more you earn, the less good a deal Social Security is for you. Your wealth is lower. Lower life expectancy groups have less Social Security wealth. Why is that? Because they receive benefits for less time, right? If you die at 67, Social Security is a bad deal for you. You'll get at most 5 years of benefits if you took an early retirement, but you'll have paid in your whole life. So this is something that, people who have more income tend to live longer. So this is a way in which sort of Social Security is non-progressive in a way, right? Because the longer you live, the better deal Social Security is for you. In a lot of other ways, Social Security is structured to be redistributive, right? With the higher replacement rates for low earnings, there's various factors, but this is one way where it's not so redistributive. Because the longer you live, the better deal Social Security is for you. And finally, singles and dual earning couples have less Social Security wealth. And that's because if you're a married couple and one of you has worked, let's say, and the other has not worked, so that one person has paid taxes, but you're entitled to his or her benefit, plus the spouse is entitled to 50% of that benefit, even if they've never worked. It's called the spousal benefit. So that's a good deal, right? Being married and only one of you working is a pretty nice deal. Dual earners have paid more if they've because of the cap, right, and the fact that replacement rates are higher for lower income. Dual earners are not going to do as well. And second, single people, because they don't have the spousal benefit, won't do as well. So yes, Social Security wealth varies substantially across people. So we've talked a lot about the moral hazard cost of social insurance, and we'll talk more about it in a minute, but it is worth pausing to reflect on actually the success of Social Security. So Social Security has been tremendously effective in reducing elderly poverty. So if we look back, we aren't talking about the Great Depression, right? We're talking about 1959 here. It's not that long ago. In 1959, more than 1 in 3 elderly people lived below the poverty line. Right? When I say elderly all day today, I mean people over 65. I don't actually think someone who's 70 is elderly, but it's a nice word for the whole thing. So if you're over 65, you're considered elderly for today. So elderly poverty rate was 33, 34% in 1959. So the face of poverty not very long ago was to some degree, to a large degree, old people, right? Old people. And over the course of the subsequent 50 years, we have seen the poverty rate basically fall by 2/3 for old people. That's the red line. It's come all the way down to maybe 9% today. And that's a tremendous change. It's a huge change in sort of who the poor are. Today, the face of poverty is actually a child, right? Many of you know this, that the majority of poor people are children. But it used to really be old people substantially. And that change in poverty rates, there have been studies, one by Gary Engelhardt and John Gruber, that basically attributes that entire change in elderly poverty to Social Security. And so, there are lots of problems with Social Security. There are lots of problems with social insurance programs. But this is a huge success. This is a huge success. We spent a lot of money on Social Security, and this is what it's bought us. This is what it's bought us, is that people are not old and destitute anymore. Oh, and the people who today are old and poor are typically people who didn't pay into Social Security. So there are people who, their spousal benefit is very low because they were married to someone who did not pay in very much, and they themselves never worked. And there is a program called SSI, Social Supplemental Insurance, that does provide some benefits, but it's not as much of insurance as Social Security. And so the people who really are very poor, people who aren't really eligible for Social Security or not eligible for very much Social Security, because that's who sort of still remains below the poverty line in their old age. But there are consequences to Social Security that are less than thrilling. So this is a plot of a hazard rate, the hazard rate for retirement. What a hazard rate is simply tells us if you've gotten to this point and haven't had the event occur yet, what is the probability the event occurs? So this is saying that if you're 60 years old, and you have not yet retired, these blue lines plot what is the probability you retire this year. If you have not yet entered the state, what's the probability you enter the state? So these are retirement hazard rates. So back in 1960, there was no early entitlement age. You couldn't claim your benefits early. You had to wait till your full benefits age, roughly 65. If we look at the hazard rate in 1960, at age 60, we see no blip, right? It seems very much sort of bobbing along. It seems typical for, there's no difference between 59 and 60 or 60 and 61, right, in the ages. In 1970, we introduced the early entitlement age. And what do we see? We see the emergence of this spike. You're much more likely to retire at 62 than at 61, right? The early entitlement age seems to be drawing people out of the labor force into retirement. We don't see a similar blip at 62 in 1960. We go down to 1980, where maybe there's been more information about this, people fully understand early entitlement better now. In 1980, in fact, the age you're most likely to retire at is 62. It's more common than 65. That's true today. 62 is the modal age of retirement, the early entitlement age. So this suggests that the existence of Social Security, your ability to draw benefits starting at 62, has led people to change their retirement behavior, right? And changes in behavior due to being insured is what we call moral hazard. Yeah, exactly. Exactly. So solvency. Solvency is also an issue. One of the things driving the solvency problem is that there's a lot more old people relative to how many people are paying into the system today. There are a lot more benefit recipients per worker paying in than there were historically. So this goldenrod line plots the number of elderly per 100 working age people. Back in the day, in 1950, 100 working age people were supporting the benefits of roughly 12 or 13 recipients, or Social Security benefit recipients. Today, that's more like 31, 32. Right? That's a huge increase in the ratio of dependents, of Social Security dependents to Social Security sort of supporters. Why has that happened? Well, I'll get to your question of Matt in a second, Matt. So there's a few reasons why the dependency ratio has increased so much. The first is simply improvements in life expectancy. The average man who makes it to 65 today can expect to live 4 more years than at the inception of Social Security. The average woman who makes it to 65 can expect to live 5 more years than at the inception of Social Security. So life expectancy has gone up. Working time, the amount of time we spend working has not necessarily increased. A lot of our added life expectancy years are entirely spent in retirement. So it's additional years of benefits that are not coming with additional years of paying in, right? That's why some people want to talk about moving the retirement age. We'll talk more about that later, but that's sort of about the change in life expectancy, or that's one of the reasons people suggested. There's been a reduction in birth rates. We don't have kids as much as we used to. So there's a lower fertility rate. That means fewer kids are being are born to support future benefit recipients. So this is, I think I've told you this joke. That's not even a joke. It's really just an anecdote from my life. That when children are annoying in stores, right? When children are misbehaving and they're being annoying, and I really wish they would just stop. I just think, thank you for one day supporting my Social Security benefits, right? I, of course, have a second thought where I'm like, if you're misbehaving in the store, really, what are the chances you're maxing out those payments, right? But nonetheless, that child will one day pay for my Social Security, right? And that's one reason to be warm and friendly towards children. Okay, there's also the demographic bulge associated with the baby boom generation. So this is a temporal rise in the dependency ratio, but the truth is the baby boomers make things worse, but we have a solvency problem even without the baby boomers. It's not like when the baby boomers go, fully retire, right? The grand retirement of all. It's not like this problem goes away. This problem is a general trend, and they're just not helping. And there's also reduced immigration. So reduced immigration makes the dependency ratio worse because typically we don't let people who are already retired in, right? And even if we do let them in, they're not going to draw Social Security benefits very much. So most immigrants are working age. So they're coming in and paying into the system and helping to support the current old. So there are more workers that support the current recipients. So immigration generally helps the dependency ratio. Also, on average, immigrants tend to have higher fertility rates than natives. And so that's another way it helps the dependency ratio. Matt, you had a question?
And I'd like to add in the reduction in immigration. Is that so referring to legal immigration? Or because, as you mentioned before, illegal immigrants
Can be a help, yeah.
sometimes can get a Social Security number.
Pay into the system,
Social Security system, but not
claim benefits. So I guess it's immigration in general. Yes, and whatever illegal immigrants are paying in and not getting benefits, they're just even better, right? That's helping even more than other immigrants. But and also increased smoking and drinking and all that would help, right? People who just don't make it to old age would also help. But so yeah, we could add declining smoking rates to this, but that stuff is smaller. I mean, it's real, but it's smaller. But yeah, you're right. It's a twofer with immigration. It's both legal and illegal that could help Social Security if we had more of them. Yeah, if we had more immigration. Okay. Oh yeah. Yeah, sure, of course.
Was the chart for the retirement hazards?
Mm-hmm.
Does that represent a certain socioeconomic group, or I mean?
This is everyone.
Those beyond the 110,000
Well, because it's the ability to draw benefits. It's not really the paying in. I mean, it's a net benefit calculation for sure. If you're not paying much taxes, maybe you don't mind it as much, but it's about drawing benefits. You're qualified to draw benefits. That really is leading people to retire, we think. This is across the whole population. This is not cut in any way. Yeah. I mean, it'd be interesting to look at it by groups. To some degree, one of the reasons we think people are retiring is that they're liquidity constrained. They would have liked to retire even earlier than 62, but they couldn't sort of fund it on their own. They couldn't borrow against their Social Security wealth, for example. And so higher up in the income distribution, we think that liquidity constraints are less of an issue. And so Social Security may be less of a trigger, right? Like, they have enough retirement savings of their own that if they want to retire a few years early, they can. While someone who's lower down the income scale really has to wait to get government benefits in order to quit working. That makes sense? So I think I would suspect we'd see differences by income category. I would think so. Also, I mean, part of it too is, you said SES, and I said income just now. But even SES, I think if we look at different kinds of jobs, retirement is a very different decision for people with different kinds of jobs, right? I think we hear about this during the Social Security debates, right? That someone whose job is very physical, working an extra year, right? Waiting, not retiring at 62, but retiring at 63, may be much more difficult for someone whose job is very physical versus someone whose job is, at a desk, right? Where an additional year of working between 62 and 63 is not fun, but is not as doesn't create as much disutility after someone whose job, involves sort of manual labor, right? Where it's actually really hard to do as you get older. So that I could imagine that this chart would look different across sort of types of work too. I mean, professors, we all know, are around forever, right? They never really retire. Anyway, but other questions? These are really good questions. Other questions? Okay. The trust fund. Okay, I'm going to talk very quickly about the trust fund because the book does a good job of explaining it. The trust fund exists because in the 80s, the Greenspan Commission, yes, that Greenspan, that commission decided to increase Social Security tax rates to prepare for the fact that we were going to have to pay out a lot of benefits to baby boomers and future generations, right? They increased tax rates beyond what the benefits paid out in those years were. So there was more coming in terms of Social Security taxes than was being paid out in terms of Social Security benefits. That difference was written down in a book. And that book is called the trust fund. The trust fund is a accumulation of all of those differences between revenues and payouts for all of those years. And it's a large trust fund. But it isn't a pile of cash somewhere, right? There is no trust fund room at the US Treasury that holds stacks of gold or something. The trust fund is entirely invested in non-marketable US Treasuries. Really, this is like the right hand of the US government telling the left hand of the US government it owes it money. We call this off budget in the sense that it's a separate account than the general deficit. But what we really care about as a country is what? How much money we have to borrow from other Americans and from foreigners in order to pay for what we spend versus what we take in as tax revenue, right? That's the unified budget deficit. That's the combination of our general spending deficit and the trust fund that year, and the increase in trust fund that year. That's the unified budget deficit. That's the thing that matters. The Social Security Trust Fund, to some degree, is kind of an accounting. I don't want to say gimmick. It's an account, right? It's an accounting notation. But it does not mean that there's a pile of cash out there to pay these benefits from. What it does mean is that we have taxed the labor supply of Americans for decades in order to justify the spending we will do for Social Security, right? It is a sort of, we dedicated that revenue to Social Security. We've made promises, and we've actually raised the revenue to keep those promises for many years from now, right? But it's not a pile of cash that that we're doling out. Social Security, like Medicare, is a pay-as-you-go system. Current recipients, their benefits are paid for by the taxes of current workers, and because of current workers, it's a pay-as-you-go system. But the way I think of the trust fund is that we have a dedicated revenue source and revenue stream. Social Security taxes go to pay for Social Security benefits, and this was a way we helped keep that true for longer, right? It's not that it's a pile of cash, but it's not nothing. It's not a figment of our imaginations at the same time either. It's something in between, is the way I think of it. Your book does a very good job of talking about it, but the key is to realize that there is no pile of money. There is no trust fund, really. When you do your really fun Social Security memo, yeah, when I say really fun, I know what you guys really think. But it will be kind of fun. What it is an actuarial prediction of what's going to happen to Social Security. And you're going to propose your own reform to Social Security, and you'll see how the balances of the trust fund and the general Social Security system change. It's sort of a cool assignment, and the trust fund will be something you deal with in this assignment. You'll learn more. And you know, it is an account, and you have to add them together, but there is no pile of cash, is the way to think of it. Okay, yeah.
So that solvency graph that you showed
The dependency ratio, yeah.
is inclusive of trust funds? Or-
That's just the dependency ratio. It's not a number, right? It's like a number of old people to young people.
Okay.
Yeah. Okay, so we can go through this. The bottom line is that Social Security and Medicare remain pay-as-you-go systems. Okay, what are so this is the implications of insolvency. The key is that what really matters to capital markets, right? And so the whole deficits and debt lecture we had. Why do we worry about deficits? Because they've reduced national income. They've reduced national income by reducing domestic investment or by increasing foreign asset holding, such that the returns to assets are going to foreigners. That's the whole net exports channel. Remember, it's investments or net exports. When there's less investment in the U.S., there's less income being earned in the U.S. because there's less capital in the U.S. When our imports exceed our exports by a lot, it means that foreigners own more of our stuff, and the returns to that stuff are going to foreigners, right? So all of that means there's less national income. That's why we care about deficits. Social Security's insolvency matters because it adds to the deficit problem, right, to some degree. Eventually it adds to the deficit problem. Right now it's helping, eventually it hurts us. What matters is the unified deficit. Okay, so what are our reform options? This is the fun part, right? Is this the end of class? It is. Okay, we're going to stay 2 minutes extra. We're going to get through this, and then we're going to call it, and we'll talk about the other programs next time. Okay, so our reform options. If we want to keep the basic system we have, we can raise Social Security taxes. We can do that by raising the Social Security tax rate. We could raise that cap, right? We could raise that cap from $110,000 to something higher. We've talked a lot, we've talked off and on in this course about rising income inequality, right? The U.S. has more income inequality today than it had previously, had 20 years ago, 30 years ago, 40 years ago. So what does that mean? It means a greater share of national income lies above the cap than before, right? There's a proposal for reform that I'm going to post this article on the website. You don't have to read it. It's not required reading, but if you're interested in it, it's a reform proposal proposed by Peter Orszag, who used to head OMB during a few years ago, and then Peter Diamond, who is an economist at MIT and won the Nobel Prize I think 2 years ago. So there you have this reform proposal for Social Security. One of the things they suggest doing is, you know what, let's have the same fraction of salaries and wages exempted from Social Security taxes. So we'll move the cap up such that the same fraction is above the cap as was true 25 years ago, as there was one of their suggestions. So we can increase Social Security taxes by increasing the tax rate or by expanding the tax base. We could cut benefits. There's a bunch of ways we can cut benefits. We can just cut benefits. We could reduce cost of living adjustments. We could change indexing, right? We could also, there's also some talk of always increasing the retirement age, right? Saying no more 65, let's make it no more 67, let's make it 70. The Diamond and Orszag article, if you're interested, explains how that's really just a benefit cut, right? Because you can always opt for early benefits, for getting your benefits early. What happens when you get your benefits early? You get less in benefits, right? So really changing the retirement age and cutting the benefit level are really just two ways of doing the same thing. It's two ways of doing the same thing. All talk about changing the retirement age is really just reducing benefits. And it's not even a special way of doing it, it's the same way of doing it. The one thing it does is it makes the benefit cut, when you raise retirement ages, right, everyone faces that decision. It could be different across people who have different life expectancies, right? The benefit cut varies by your life expectancy when you choose to do it that way. But it is all sort of the same puzzle. It's all the same thing. It's all benefit cuts. We could raise other taxes and start paying for Social Security out of general revenues, right? That's what we'll do when the trust fund runs out. We will be paying for it through general revenues. We could raise other taxes. Some people talk about, rather than jacking up Social Security taxes even higher, creating like a carbon tax, right? A Pigouvian tax that combats an externality and using that to pay for Medicare and Social Security. So you could create another tax. We could cut other non-Social Security spending and use that savings to help pay for Social Security. That's tweaks to the current system. We could also increase the number of younger people paying taxes. We could do that through increasing immigration. We could offer fertility incentives. We could, you laugh, but other countries do this. Other countries pay people for having kids. we could also, there's a third option, this is in the Diamond Orzag article that I'll post. So state and local government workers are not, most state and local government workers are not part of Social Security. They have their own private pension system. And we could grab them and put them into Social Security, right? Because they're state and local government workers, they have pensions that are like accounts. They're like business pensions, right? Where there's money actually saved in an account for their retirement, the pension funds that all invest in private equity firms, right? That's what those are. So the benefits that need to be paid out are already actually physically exist at the state and local level. But we could grab current workers and throw them into Social Security, and that would just increase the number of working people supporting the current old, right? That's another way to expand the number of young workers. And then we have our fundamental reforms. One of them says, let's start building up a real trust fund, like an actual pile of dollars. And let's start investing that in the stock market. Because right now, the increase in Social Security payments is entirely dependent on wage growth and population growth. Why not get a rate of return that the S&P gets, right? Why don't we go invest this stuff? It's a really interesting idea, right? And I think there's often discussion of creating like a Social Security investment trust that is hands-off, like the Federal Reserve, right, where sort of politicians can't meddle with it. But as we've seen in the financial crisis, the hands-offness of the Fed can be variable, right, at times. It can be slightly more, politicians talk a lot about the Fed right now. It's not, it might be hands-off to some degree, but I mean, there's a lot of discussion of the Fed in the political sphere. We could imagine a world in which, someone stands up on the floor of Congress and says, tobacco kills more Americans than blah, blah, blah. How can the US government be invested in tobacco companies? And the Congress votes and they stop investing in tobacco companies. Someone else can get up and say alcohol kills so many Americans per year. The US government should not be investing in alcohol. So we stop investing in alcohol firms. Someone else gets up and says, we're invested in these private prison corporations and we shouldn't be on the supply and demand side of that market. So we stop investing in those corporates. Eventually, if enough objections, right? Are we invested in a diversified portfolio? No, right? And we could really be taking on a lot of risk. And so that's part of the problem. Also, this pile of money could become very large, right? And we would own a significant amount of the equities market or the bond market, and that could also be troublesome. Okay, so that's it's an interesting idea. It has some sort of implications that we have to think through. The last thing people talk a lot about, the last thing I'll say, is private accounts, right? Where we're gonna, instead of taking your tax dollars and putting them in the big pile and then paying them out to people who are old now, we're gonna put we'll have an account with your name on it, and your money will go into that account, and you can maybe manage it a little bit. You can choose between a few funds, and that's how we'll fund Social Security. It'll be a funded system, no more pay as you go. Your dollars won't pay for someone who's old now, they'll pay for your own retirement. The problem with that plan, right, the complication that's hard to deal with is, that's great. That'll be a great system where Vincent's tax dollars go into Vincent's account and funds Vincent's retirement. But Vincent's got grandparents, and they need benefits today. And who is going to pay for those benefits if Vincent's tax dollars are going to pay for his retirement? Who's going to pay for the retirements of people who are old today? That's the question that private accounts have a hard time dealing with, right? Because what is the fundamental problem with the solvency of Social Security? It goes back to the Great Depression. It goes back to the creation of Social Security. Social Security was partly created because old people who had saved for their retirements saw their assets wiped out by the Great Depression. Their savings was worth nothing, right? And there was this tremendous need, this humanitarian need to not have poor people in the streets, right? Begging in the streets. So we created a program that both redistributed towards old people who lost everything in the Great Depression and created a retirement savings program for everybody. But that first generation of recipients got benefits without ever having paid taxes. We call that the legacy debt of Social Security. And that is what's part of haunts us today. The solvency issues are partly that we never really paid off the legacy debt. Some people got benefits without ever paying taxes. So what that meant is that because the young during the Great Depression paid taxes and old people got benefits, when the young of the Great Depression were old, someone had to pay their benefits. It was who was working then, right? This pay-as-you-go system was created by the fact that we had to pay benefits to people who never paid for the system because of this cataclysmic event. And that is the question that private accounts, to be a really credible reform option, have to sort of address. One idea is that we phase it in. Just a little bit of your money goes into your account now. Your grandkids will have a fully funded Social Security system over time. And that could be more feasible. Last comment, yep.
The legacy argument, don't the people who died before have collected benefits throughout the past how many years?
They have not accumulated, because we also keep increasing benefits, the other thing. Yeah, that also, and yeah, we keep increasing benefits as part of it too.